Most investors think the AI boom is over, but the serious money is quietly shifting into the boring layer that makes enterprise AI work. Today, we're breaking down NowVertical Group, trading under the ticker NOW on the TSXV Venture, 5XQ in Frankfurt, and NOWVF on the OTC. As I'm recording this, the stock trades around 30 cents Canadian, but prices can change quickly. In this video, we're going to walk through what NowVertical actually does in plain English, why some investors see it as a misunderstood enterprise AI play, the real risks you need to understand, and what kind of investor profile this type of setup might fit. Quick reminder before we go any further, I'm not your financial advisor. This video is for educational and informational purposes only, and is not financial advice. Penny stocks and small caps are very risky, and you can lose all your money, so always do your own research or talk to a licensed professional before making any decisions. So what does NowVertical actually do? At a high level, NowVertical helps large organizations use their own data safely and productively with modern analytics and AI, not consumer AI, not chatbots for fun, but enterprise systems inside banks, governments, and regulated industries where mistakes are expensive. Most big organizations already have data everywhere. Transaction records, customer files, legacy databases, PDFs, spreadsheets, and systems that were never designed to talk to each other. On top of that, regulations like GDPR and local privacy laws make it dangerous to move or expose sensitive data. NowVertical sits in that last mile between messy enterprise data and advanced analytics or AI tools. They don't replace cloud platforms like Google Cloud or Snowflake. Instead, they integrate into them. Their software and services pull data together, clean it up, apply governance and privacy controls, and make it usable for analytics teams, decision makers, and increasingly, autonomous AI systems. In simple terms, the big tech platforms provide the engine, but NowVertical builds the transmission and guardrails that let that engine actually be used inside specific industries. That leads directly into the bull case. The first bullish point is the shift from acquisition chaos to operational discipline. For years, NowVertical operated like a roll-up. They acquired multiple boutique data firms across regions and industries, which built revenue but created complexity. In 2024 and 2025, management made a clear pivot to what they call one brand, one business. They unified sales teams, integrated product offerings, and focused on cross-selling multiple solutions into the same clients instead of chasing one-off projects. In 2025, revenue tied directly to this integration strategy grew sharply year over year and now represents a meaningful portion of total sales. That matters because it signals this is no longer just a collection of small consultancies. It's becoming a single operating business with shared customers, shared technology, and shared incentives. The second bullish point is margin resilience and improving profitability. Even though reported revenue dipped in 2025 due largely to currency effects in Latin America, the underlying profitability story improved. Gross margins held around the low 50% range, which is strong for a services-heavy enterprise data business. More importantly, operating income and adjusted EBITDA improved year over year. That tells you management cut low-quality work, tightened costs, and focused on higher-margin strategic accounts instead of chasing every dollar of revenue. This kind of margin behavior is often what investors look for when a small company transitions from survival mode into operating leverage. The third bullish point is balance sheet de-risking. In late 2025, NowVertical fully retired its outstanding convertible debentures. For a microcap, this is a big deal. Convertible debt creates constant dilution anxiety and puts a ceiling on valuation. With that overhang removed and restructuring costs largely behind them, management has indicated that the business is positioned to move toward positive free cash flow. That transition, from externally funded operations to self-sustaining cash generation, is often a key psychological inflection point for the market. The fourth bullish point is validation through partnerships. Particularly with Google Cloud, NowVertical has achieved premier partner status in key regions and was named Google Cloud Data Analytics Partner of the Year for Latin America. These designations aren't just marketing badges. They determine which partners get referred enterprise clients directly from Google's own sales organization. That kind of channel relationship lowers customer acquisition costs and shortens sales cycles. In recent periods, the Google partnership contributed millions in revenue and generated a growing pipeline of enterprise opportunities. For a company of this size, being embedded inside a hyperscaler's ecosystem can materially change growth dynamics if execution remains strong. On paper, that's a compelling story. But it's only one side of it. If you're getting value from this breakdown, tap like and subscribe to Penny Stock Pulse. It really helps the channel and tells me to keep making these deep dives for you. Now let's talk about the risks, because they are real. The first risk is geographic and currency exposure. A meaningful portion of NowVertical's operations and revenue come from Latin America, particularly Argentina. Currency devaluation can distort reported results, make revenue appear to shrink in dollar terms, and create volatility from quarter to quarter, while lower local costs help margins. Investors still have to accept that reported numbers may not reflect operational reality cleanly, especially during periods of macro instability. The second risk is customer concentration. A large percentage of revenue comes from a relatively small group of strategic accounts. These are high-quality multi-year clients, but losing even one major banking or government customer could materially impact results in a given year. That's the trade-off of focusing on bigger, stickier clients instead of a broad base of small ones. The third risk is execution risk in integration. Management has made real progress integrating teams across regions and cultures, but this is still an ongoing process. Retaining specialized data talent, maintaining consistent delivery quality, and keeping teams aligned across the US, UK, and Latin America is not trivial. For a small enterprise software company, people risk is always one of the biggest variables. The fourth risk is liquidity and market structure. With a market capitalization under 30 million Canadian dollars, this is an illiquid microcap. Large investors can't easily enter or exit positions without moving the price, and short-term volatility can be extreme. This is not a stock designed for frequent trading or tight stop-loss strategies. So how do some investors think about valuation and context? At current levels, NowVertical trades at low single-digit multiples of adjusted EBITDA, based on recent run rate performance. Comparable enterprise data and services firms, even those with slower growth, often trade at materially higher multiples. That discount reflects microcap risk, geographic exposure, and skepticism left over from the company's acquisition-heavy past. The re-rating case depends on continued profitability, free cash flow generation, and evidence that organic growth can stabilize as currency headwinds normalize. There's no guarantee that happens, but that's the asymmetry some investors are evaluating. So who might a setup like this be for? NowVertical may appeal to investors who are already comfortable with microcap volatility, understand enterprise software and services models, and are specifically looking for turnaround-style situations where operational improvements matter more than headline growth. It's not a momentum trade, and it's not suitable for anyone who needs liquidity or predictable short-term price action. It sits in the higher-risk, higher-variance part of the market, where position sizing and time horizon matter more than precision timing. To recap, the bull case centers on a completed operational pivot, improving margins, a cleaned-up balance sheet, and strong hyperscaler partnerships. The bear case is currency volatility, customer concentration, execution risk, and the realities of microcap liquidity. If the company continues converting operational improvements into sustainable cash flow, the market may eventually reassess how it values the business. If not, the risks remain front and center. If you found this deep dive helpful, hit like, subscribe to Penny Stock Pulse, and turn on notifications so you don't miss the next Under the Radar breakdown. Thanks for watching, and I'll see you in the next video. If you'd like, I can also generate a VO plus visuals version, plus a thumbnail prompt and full YouTube metadata for this script.